Good morning and welcome to Stock Market Today. It's Friday, May 22nd, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Shaken Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Shaken Analytics. Head over to shakenanalytics.com/today where you can sign up for a free email where I get a lot of the content for this show, as well as give you daily stock ideas to consider that hits your inbox every trading day before the market opens. So U.S. equities were mostly lower in Thursday's trading as trade tensions between the U.S. and China have elevated, though the Russell 2000 managed a small gain. Industrials were the only group to close higher on the day. Energy was the biggest decliner. Treasuries were flat for the most part. The dollar was stronger against the euro and little changed against the yen. Gold finished down 1.7%. Crude oil was higher by 1.3%, gaining for a sixth consecutive day. Now, as we get to the desk this morning, some of the news out of Hong Kong overnight has S&P futures down 0.5%, but off their pre-market lows. Asian markets were lower overnight, led by Hong Kong, which lost about 5.5%. European markets are mostly weaker, but also off their lows. Treasuries are stronger. The curve is flattening. The dollar is weaker against the risk-sensitive yen cross, but stronger against the euro and sterling. Gold is up 90 basis points, and WTI crude is giving back 5.5%, but still has had a strong string of gains. Now, for the S&P 500, taking a look at the structure here, could not build on the previous day's strength, but did manage to kind of hold right around that 2950 resistance line. The 200-day still looms overhead at 29.99, and that really is kind of the key area. We're in the zone right now. We're 2 points below the zone, if you will, of resistance in the 2950 to 3000 zone. On the downside, we tweaked up yesterday. We tweaked up our initial support level to 2800 to 2850. Below that, you have to start thinking about 2490 to 2670 as key retracement levels. The 13-period CCI and its 3-day moving average are moving toward overbought levels, and shaken money flow is, let's call it flat, right? We dipped into bearish territory, but have now gotten back to the flat line. So that's the structure of the market here. I think the onus is on the bulls to push the market through that 200-day moving average, which then opens the door to kind of 3110 to the upside. And then after that, we can start thinking about the highs. Now, similarly, the Qs have closed this gap and faded. You can read about that and see it in some of the work that I've done throughout this week. So that's the structure of the S&P 500 here as we enter the Friday before a 3-day weekend. And just as a reminder, there will not be a show on Monday as the market is closed in the U.S. for the Memorial Day holiday. Taking a look at our market in a minute now. This is what we're talking about in our note today. SPY remains below the key 300 resistance mark. We hit on that. And that's coming as high yield meets resistance relative to Treasuries. We'll take a look at what that looks like a little bit later on in the show. Small caps show continued signs of improvement. And again, we're the only group to close higher on the day. Semis trade near relative highs, but a momentum divergence is in play. And futures, as I said, do point to a lower open here today. So if we shift over and look at the major indices from a power bar perspective, the Dow loses 28 basis points yesterday, and the ratio actually improved slightly. 5 bulls to 10 bears. The S&P 500 down 72 basis points, 69 to 153 bulls to bears there. The NASDAQ was an underperformer, down 1%, a little over 1%, 31 to 15 bulls to bears on the NASDAQ. Small caps, the only group, as I said, to finish higher on the day yesterday at the major market level. 419 to 319 bulls to bears, holding a bullish ratio, but bonds uptick, sending yields lower. According to the Chaikin Power Bar, large cap stocks are more bearish than small cap stocks, and major markets across the board do remain mixed. Taking a look at our stock of the day now, and this is one that we were bullish on for a long time, right? And it had a nice run, but when the facts change, you have to change your mind. And Lam Research is a great example of that. It has a bearish rating, It's a weak trend. Now, semis are still a strong industry group, but the trend here is weak, meaning that it's below its declining long-term trend line. So if you are thinking about looking at some stocks in the semi space, Lam would not be one that I'd be looking at as a long idea. If we take a look here, you can see the consolidation that's playing out. Now we're lagging the market. So we have a bearish stock lagging the market. Look at the intensity of this bearish money flow as the stock is now overbought based on our indicator. What's a really interesting feature here at Chaikin Analytics is what we call our checklist. The checklist tells you what you want to buy or sell, right? And then timing, when. So if we look at a stock like Lam, we can see that it has a bearish rating. It's underperforming the market. Now, the industry group is strong, but that's the only green check mark it has. It is overbought, it's below its trend line, and money flow is weak. So the weight of the evidence certainly points away from Lam being a long idea, actually points at the potential for it being a bearish idea, in my opinion, especially if the bearish divergence in semis on a relative basis that we're going to look at later on in the show begins to be confirmed. And we'll talk about what that means when we get to that chart. Let's look at our sector tracker now. Movement of the major sectors over the last 5 days. Energy industrials at the top of the list. So again, we started talking a little bit about that reflationary basket of sectors doing better here in the near term. And that's what this speaks to, in my opinion. Discretionary and comms round out the top 4. Materials are an area of the market where we are certainly warming up, at least from a relative trend perspective. Financials, tech, and REITs, kind of middle of the road. We'd like to see financials do better, but that just does not remain the case. Technology, obviously, the largest weight in the S&P 500, so we want to see that group continue to lead. Real estate, staples, utilities, and healthcare. It's your defensives at the bottom of the list over the past 5 days. Now, the market's had a strong week, notwithstanding some pressure on the futures here on a Friday morning. So you're seeing maybe a bit of a rotation out of the defensive areas of the market. Remember, on Tuesday, we highlighted that relative stalling in healthcare, and I think you really want to pay attention to that. I know we are, because healthcare has been one of our favorite areas of the market. Our industry in focus, software and services, which has been leadership over the past 6 months, leading by a little less than 5%, and that power bar ratio is very strong, 44 bulls to 10 bears there. It's currently ranked number 3 of 21 subsectors, and it's moved up 1 slot over the past week. So some of the names there that warrant some extra work, some extra attention: SAIC, A10 Networks, ATEN, and EBIX, EBIX, all with very bullish Chaikin power gauge ratings. And let's take a look here at the fund itself. Has a bullish ETF rating and is in a strong trend, right, above this now rising long-term trend line. We talked about the ratio, but what's interesting to me and what I pay close attention to is the relative strength. Now, it tried to get going tail end of March, early April, and then faded, but now we've seen the intensity of outperformance really begin to pick up. Money flow is bullish, neither overbought nor oversold, as we kind of wrestle with this breakout level similar to what we're seeing in the S&P 500. So, to the extent that we break out, we do want to focus on the leading areas of the market. Software certainly fits the bill as one of the leading areas of the market. So, that's an area where we will be focused if we do get that breakout through the 300 mark on SPY. So let's dig in now to yesterday's movers and shakers. We'll take a look at what's trending, our gainers and losers. L Brands, right? This actually is interesting because a lot of these names were on the other side of the board yesterday. L Brands earnings announcement sent that stock higher by about 18.25% as they kind of gave some detail about same-store sales leading into the COVID shutdowns. The Gap, no real news there. I think it went along for the ride with L Brands. They're up 11.5%. Norwegian Cruise Lines was initiated with an outperform rating at Credit Suisse, and that was enough to send that stock higher by 9.78% on the day. CB, they announced 2 days ago, rather, on the 20th, they announced that they were going to increase their dividend. I didn't see anything company specific in the trading yesterday to add 8.1% to that stock. Kohl's, I think it's kind of, again, going along for the ride after that L Brands print. Kohl's up 7.84% on the day. Loser side of the board, National Oil Well Varco, it's a bearish stock in the energy space, and they said that they were suspending their dividend, which took 6.7% out of the stock. DXC, nothing company specific there, down 6.6%. Boston Scientific filed and priced a secondary offering. So the news of that secondary sent the stock lower by 6.5%. Take-Two reported earnings. Investors didn't like what they heard there on that bullish stock, down 5.9%. In AES, nothing company specific to drive trading, down 5%. And that name on the day. Let's take a look at what we're writing about today. It's Friday. We look at the key themes and relationships. And I think one of the key themes that I like to watch is high yield relative to treasuries as a kind of a metric for risk appetite in the marketplace. And what's kind of interesting to me is that as SPY is, fighting in that resistance zone, this ratio is doing the same, right? You've got this kind of consolidation from back in 2015, 2016, and now we're seeing consolidation here once again. Below the 200-day moving average, RSI fighting to get out of bearish ranges, but so far struggling to do so. And that's all playing out as treasuries, while not precipitously declining the way they had been, do appear to be bid, keeping a lid on yields here in the near term. So this one's really interesting to me, just because it speaks to risk appetite in the marketplace. And I think a break through this resistance zone for the ratio that coincides with a break up and out for the S&P 500 would really have bullish implications. This would send a bullish message. I also want to highlight, though, that this has been rolling over since really late 2018 as rates have been declining. So that slowing growth theme that we've been talking about for a while has really been evident across asset classes and not necessarily in the equity market, which to me speaks to the importance of paying attention to what's going on in other asset classes. Even if you don't trade them, even if you only invest in equities, I think you need to be aware of what's happening in the fixed income market, in the commodity market, because they could paint a picture that impacts relative performance, at least at the equity level. This one has really caught our attention here. It's the divergence between SMH and SPY, right? The ratio trading near the highs, right? We are consolidating on top of a consolidation above the 200-day moving average. It actually did make a new high earlier this week. But what bothers me about this ratio is the fact that with each of these successive new highs, we are seeing lower highs for the RSI. Now, haven't seen the breakdown yet, but that needs to be confirmed. But you can picture a situation where if we do get confirmation by the ratio breaking down, leading to further weakness in the SMH itself, all of a sudden that Lamb research that we talked about could really start to come under pressure. So this is something that I'm watching very, very closely because I think a breakdown here, number one, could have bearish implications for the market. And number two, obviously bearish implications for the bearish names within the semiconductor space. So it's something we want to really keep a close eye on. And then finally, with trade tensions elevated between the US and China, I'm watching this one pretty closely. This is the CQQQ, the China Technology ETF that has made a series of lower highs within this kind of big picture consolidation above the moving averages. Now the RSI is beginning to move lower after just tagging an overbought level, and CQQ against the SPY still in a similar consolidation. But a lot of the kind of big names that people are focused on, JD, Alibaba, fall into this group. So I wanted to call it out today as tensions are becoming elevated between the US and China on the trade front. So just something to watch and keep in mind. That's going to wrap us up. We are offering our 14-day trial, but I want to take the time now to thank you all for carving time out of your morning to spend it with me each day. I hope you all have a great 3-day holiday weekend and, in a shelter-in-place manner, still manage to kick the summer off in the right direction for Memorial Day weekend. I will be back here with you on Tuesday. No show on Monday. Please be well and be safe, and have a great weekend.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.